Okay, good afternoon, everybody, and welcome to today's webinar. It's a pleasure to have so many on this first webinar that I'm doing of 2023 from here in the UK. I hope wherever you are, you're keeping well across Hong Kong, Singapore, and looking forward to Chinese New Year. First one I'll miss in 16 years, having now been based permanently into the UK. And of course, we've got lots of people tuning in from the UK, Europe, and early morning in the US as well. So we'll get the webinar going today. Today's subject is going to be essentially about the UK market, a market that I've been immersed in for the past 6 months now permanently, and I've got a very good handle on what's going on here. And I just wanted to share some of those thoughts from the UK. So Bella, let's get into the first slide if we can, please. So there's a lot of people on the webinar today who are not familiar with IP Global. So let me share a little bit of background. So starting with myself, I've been in the business since 2006. I started in Hong Kong, which is our head office. I moved to Singapore in 2009 to set up our Singapore office. I lived in Singapore for 3 years and overall spent 16 years in Asia. As I mentioned, I'm now back in the UK, and I will actually be out in Hong Kong and Singapore in the next few weeks, and I will share my dates actually towards the end of this presentation. So in terms of the business, we've transacted on over 5,700 properties, $3 billion of property investment across 18 countries. So we have tremendous experience in investing in property in city centres globally. Next slide, please, Bella. Okay, so in terms of track record, these are some of the main markets we've invested in amongst the others. Australia and the US, we invested heavily in for quite a number of years. Right now, predominant focus is in the UK and Germany. We have invested actually now in over 100 properties in the UK, and we've invested in Germany since 2014. So these are markets that we have tremendous experience in, tremendous understanding of. And also we invest in Portugal for the EU passport. Just at this point, I'll just share a little bit of background for those who aren't familiar with IP Global on our business model. The business model is quite unique. We effectively co-invest with our clients. For want of better words, we actually underwrite our deals. And that means we actually effectively bulk purchase property where we see an economic opportunity in city centres, where we have done a tremendous amount of research and due diligence on developers. We commit capital. We sign legal agreements with developers whereby effectively whatever we haven't sold by completion, we have to buy with our own capital. And that's quite a unique model because most property companies are purely marketing property and they're not taking financial risk. You know, we are taking financial risk. And that gives clients a lot of comfort. It gives us a lot of credibility. And that is why we've got only over 50% of clients with more than one property investment with us. Next slide, please, Bella. So once a client has invested with us, we manage the end-to-end service. So what does that mean? Well, that means we can introduce the client to a lawyer who has done all the research and due diligence on the project and can answer any questions that the client has. We can offer the mortgage service. So we have our own brokerage, Liquid Expat Mortgages, who will actually help the client all the way through the mortgage application, collate all the documents, and basically mean that the client does not have to go bank to bank to find a mortgage. Lettings and management is a key part of the proposition. So wherever we invest, we have made sure through our research that we are offering somewhere to invest that will offer a good rental yield and good rental opportunity. So we will do everything from sourcing the tenants, drawing the agreements up, putting the rent in the account, and dealing with any service issues at all. So this is something that we have tremendous experience of, and we have over 5,000 properties in the UK that we manage for clients. And then in terms of resales, we can also do everything in terms of the exit strategy. So if the client does want us to sell the property, we can manage that part too. Next slide, please, Bella. Okay, so if we look at last year, it was a tale of 3 prime ministers. We started off with the chaos, if you like, of Boris Johnson and the end of his government in the summer. When we just thought it couldn't get any worse, we had Liz Truss and that chaotic mini budget. But by the end of the year, we had a lot more solidity. We had what we really wanted was a dull, boring government, which was going to provide lots of more confidence to the financial markets and basically be more pragmatic and provide some stability to the UK economy. And that's effectively what we've seen in the short time that Rishi Sunak has been Prime Minister and has basically calmed the financial markets after the October mini budget and all the ramifications there, where effectively the uncertainty that was created through that caused sort of widespread panic across the financial services industry here in the UK. So let's move on to the next slide, please, Bella. And in terms of, what are we going to talk about today? Well, we're going to talk about the main sort of areas that investors want to focus on. We're going to talk about UK interest rates and the currency, which is obviously relevant to overseas investors. We're going to talk about the rental market, which I'm very familiar with now, obviously being close to the action here in the UK. We're going to talk about what's going on with supply and demand. And finally, Edinburgh, which is a location I was up in just under 2 weeks ago, just reviewing the project that we are planning to launch quite soon. And I'm also going to talk about some of the other markets that we are investing in. Next slide, please, Bella. So let's have a look at interest rates. I mean, of course, over the last year or so, we've seen a lot of changes to interest rates. And obviously, we'll touch on the currency as well. So this is actually a really interesting slide. So we've seen interest rate rises since December 2021, all the way through to 2022. It's likely that we're going to see another interest rate rise of around about 0.25% next month. But I think the point we would make here is that, at the end of last year, in fact, at the November Bank of England meeting, although interest rates went up at that point by quite a considerable amount, the minutes were most interesting in that the governor of the Bank of England mentioned that it was probably likely to be less interest rate rises now than more, and that potentially they would end quicker. Now, since that November meeting, what we've seen is inflation start to come off. We've seen wholesale gas and electricity prices come off. We've seen petrol prices come off. We've seen a number of other examples of inflation lowering. There are also examples of inflation that is still high when we look at food prices, etc. But the overall trend is moving in the right direction. And as we sit here at the end of January, I think we can be more confident that interest rate rises as we get through to the middle of this year would have stabilized. And then as that inflation does start to come off even further, as all the indications seem, then at some point we will then see interest rate rises going into reverse. And I think there's a few things I would mention here, that the landscape has changed very quickly, because even at the end of last year, we were talking about rate rises of potentially above 6% as a result of the mini budget, where effectively lenders could not price their mortgages because there was no stability in the financial markets. Interestingly, even though interest rates have been going up, mortgage rates have started to come down because of the stability in the financial markets, because lenders can secure funds at cheaper rates now as there is more confidence in the UK economy. And if you look at this slide at the top left here, I put this on because if you look at 1988, interest rates went as high as just under 16%. I remember it well, and I'm showing my age here, because my dad took on a mortgage at that point when interest rates were 16%. And that period, as you'll see there, interest rates then dipped quite quickly after that. We are sitting here today at Bank of England rates at 3.5%. So I think we need to have some context here into where rates are, and the fact that affordability is still very good, given that interest rates have just risen from effectively zero in a short period of time, but are more likely to go down within the next 12 months or so, as inflation does continue to come off. So let's go on to the next slide, please. So let's have a look at the pound. So again, if we sort of refer back to last year, we would have seen during the Liz Truss government, we would have seen that the pound got super weak to Hong Kong and Singapore, US dollars and others. But again, what we've seen, if you look at these charts, is we've started to see stability in the pound. Not only stability, but we've seen the pound starting to strengthen. If we have a look at the slide on the top left, we will see that 1 Singapore dollar, you would have got 65 pence for, round about the time of the mini budget. 1 Singapore dollar now, you will get 61 pence. The same with the Hong Kong dollar. 1 Hong Kong dollar, you would have got around about 12 pence. Now you've got around about 10 pence. So you will see that is clear evidence of the stability. And I think some of the reasons for that is due to Rishi Sunak's government. He hasn't been in there long, but he's taken pragmatic, solid and stable decisions. He is very focused on getting the national debt under control. He is also very focused on making tough decisions. And the fact is that energy subsidies are being cut, and also, wage levels for public employees will not be as high as everybody expects, because he's keen to keep a tight rein on finances. And all this means that it will provide greater stability. And my personal view is therefore that as we go through this year, we will see more stability and growth of the GBP. So I think that does indeed create some urgency for investors to, if they are looking to invest in the UK, to make that decision sooner rather than later. And as context to that, we have to bear in mind that, only a couple of years ago, we were talking about a Sing dollar at 220 to the pound. It's currently 163 or thereabouts. It was like 155 during the Liz Truss government, and also a Hong Kong dollar that was perhaps closer to sort of 12 Hong Kong dollars only a couple of years ago. It was as low as sort of 8.8 Hong Kong dollars around October, November. As I look at it today, it's 9.66 Hong Kong dollars to the pound, which is clear evidence that the pound is gaining some ground now, as I mentioned. And I do think the pound will be significantly stronger by the end of the year, given the hard decisions that the government will take here in the UK. So let's move forward onto the next slide. So with rising interest rates and weak pound, is it still a good time to invest in property? Well, one thing I'd say, again, on interest rates, if we look at our side, our model where we typically negotiate best pricing is in off-plan projects. So these are projects that are built in a year or 18 months' time. these are opportunities where, for example, you would not need to do the mortgaging for around about a year's time. So from my perspective, I believe the situation will be very different in a year's time. Rates will look very different, interest rates will look very different, and rates will have stabilized / come down. So actually locking in a property now means that you lock in the value now, and you will be looking at a good mortgage market in a year's time. And obviously you're going to lock in now and take advantage of that weaker GBP. But that's an interesting line here. The fact that basically, we've seen stability in the property market, and basically that therefore has led the comment to the fact that people see more stability in the property market and more faith in the property market than people here do in politicians. And I also think people are desensitized to a lot of information these days. They basically will look at the fundamentals rather than the various noise and news articles that you see that may be negative on the market. They will look through that and basically, if they believe in the fundamentals of property as we do, they will continue on likewise. And obviously, we truly recognize that property is a very strong asset, when we compare that to obviously alternatives in the market. The point I would also add, though, is it is fair to say that, in recent times and during this year, we will no doubt see less transactions because of interest rate rises. But of course, what that means to us as a business that underwrites these deals, is that where possible, we will be able to negotiate slightly better pricing. Now, that's seen as a short-term opportunity because, of course, when rates do stabilize, start to come down, those deals will be harder to negotiate. But in real time, we are negotiating on pricing right now. So we know the new launches that we bring to the market are absolutely priced very, very well indeed, and enabling our investors to capitalize on the current market position. Next slide, please, Bella. Okay, so I'm going to touch on the UK rental market. So if you look at the UK market, since COVID, what we've seen is a lot more people come into the rental market. They reckon there's about 500,000 more people in the rental market than before COVID. Why is that? Well, lots of people put off renting during COVID. They decided that they would just hunker down until obviously things settled down. We also see sharers who have gone their own ways since COVID, people who want to work from home with their own space, live on their own. And so there's a tremendous amount of more people in the rental market, but actually there's a lot less stock. And that's because COVID really slowed down planning applications. Build costs have gone up quite significantly. And therefore, we've got very, very strong undersupply and extremely strong demand. And, I really just wanted to pick out one key message here. Line 2, demand is 46% above average, whilst total supply is 38% lower. And that tells you all you need to know about the rental market right now. An extremely strong supply for demand imbalance. And again, if people are concerned about interest rate rises, what we can tell you is because of that undersupply, there is tremendously strong rental inflation, which is very, very healthy and important for potential investors to note, because that will more than compensate for those interest rate rises. It's also good to know, what sort of properties are people looking at? What are the best ones? Well, I can say across the board, it's a strong rental market. Family homes, 3 bedrooms, 2 bedrooms, 1 bedrooms. 1 bedrooms in particular, for the reasons I mentioned, are very, very strong assets. Most of our markets are 1 and 2 bedroom units, areas where They're young professionals looking to live in up-and-coming areas, close to new transport, etc. But the market as a whole is strong. And as I say, based on those figures we put there for rental inflation and also the 5-year average for inflation, the fundamentals for the longer term are strong. Next slide, please, Banner. So just a bit more, as I say, it's really sort of one bedrooms that have been leading the way with rental inquiries. And as I say, the fact is I've kept those sort of figures up there on the right because, you know, it is worth just, you know, re-emphasizing just how strong that rental market is. 5% growth in 2023, 4% in 2024, just shy of 6% of the average. And I do think these are very conservative numbers because supply is not increasing anytime soon. Indeed, the government's own mandated figures last year, where they mandated local boroughs to build a certain amount of properties, they've actually scrapped that recently because they see that because of build costs that have gone up, because of their own very slow planning rules and regulations, they fully understand and have now finally accepted the fact that they cannot build the required number of properties due to the red tape, due to these higher build costs, etc. And the fact that, as I say, it's very, very bureaucratic planning conditions that mean that, you know, projects being signed off takes an awful long time. Let's move on to the next slide, please, Bella. So just on UK housing supply and demand. So if we go on to the next slide, I mean, the UK has needed 300,000 homes a year for about the last 25 years, but it's never reached that target. And as I say, COVID has simply exacerbated that situation. So what we have now is a national shortfall of over 600,000 homes over the next 5 years. And this is up from JLL's previous prediction for an already stark shortfall of 500,000 homes. So new housing supply is expected to fall even further as a result of all the reasons that I've mentioned. So it's not just this year or next year, you know, you're talking sort of 5, 10, 15 years of undersupply in the long term in the UK. And indeed, probably beyond that, because undersupply has always been an issue in the UK market. It's one of the key reasons why investors have invested here, because they seek stability. They know that when they're investing, for example, overseas, that providing they invest in the right location, they can have confidence that they will get tenants. Next slide, please, Bella. So let's have a look in real time, you know, what's going on. So November, December, we can honestly say there was a lot of doom and gloom around. People were concerned about what was going to happen to the property market. I think a few points I would make is that we came into effectively an economic recession in the UK recently with record high employment, which has been different from previous recessions. And we came into this situation with record low supply of property, very, very different to previous recessions where we've seen a glut of property and a lot of overbuilding if we go back to the late 70s, early 80s. So that actually means that the property market is strongly underpinned. So that is really the starting point that we see. And I just wanted to pull together some data that I just pulled together yesterday, actually. So sitting here in the 3rd week of January. And what we're seeing is, you know, Rightmove have commented that average price of a home has jumped £3,301 in January, a higher rise than normally expected at the start of the year. Also mentioning that, you know, price is higher than in December, and buyer demand is up 4% compared to the same period in the last normal pre-pandemic year of 2019. Now, I've actually spoken to some agents as well, different agents in different parts of the country, and they have reflected similar, that, you know, the market is starting to pick up again post-Christmas. It's normally a quiet time of year, but in terms of early indications, they are positive that actually, you know, this year we might not see as many transactions as last year, of course, but the market is looking healthy, you know, for all the reasons that I've mentioned in this presentation. Next slide, please, Bella. So now I'm just going to talk about specific markets for a while. I'm going to talk about Edinburgh, where I was 2 weeks ago. Edinburgh is a market that we are going to launch in quite soon. We've only ever done a couple of projects in Edinburgh. It is such a tightly undersupplied market, but I was there 2 weeks ago and it was great to be on the ground. So if we go into the details for Edinburgh, this is a great picture. You know, it really shows some of the beauty of Edinburgh. In terms of a city, it is like a London north of the border. So it's a tremendous amount of wealth there. There's over 50,000 students across some of the top universities, where royalty is obviously frequented. You have a 1,000-year-old castle. You have Arthur's Seat, which is high up in the hills there. Tremendous amount of history. You have the Edinburgh Fringe Festival. There are lots of tech companies, huge financial centre. It really is a great city, and also voted as one of the happiest cities in the UK, I hear. You can't judge that with the weather because it is pretty chilly up there, but I get what the saying means, because it really is a city with plenty to offer. So let's just get into some of the detail. So behind Glasgow, second most populous city, the population is continuing to rise, and you know, population growth is one of the key things we look at when we're investing in any city. We want cities that are growing in numbers rather than decreasing. We've seen a huge spike in GDP since 2000, and this is a key line: prosperous city with one of the strongest economies of any city outside of London. And when you look at what's going on there, you know, home to 75% of the UK's potential renewable energy, ranked 21st in terms of most competitive cities worldwide, 7th most competitive in Europe, and a leading technological ecosystem outside of London. So, you know, it's got a highly skilled workforce. It's got very, very high student retention numbers, and you've got extremely bright students in Edinburgh. And therefore, that's why, you know, we see a very strong and healthy outlook for Edinburgh across its economy. Let's just get into the next slide, please, Bella. So these are some of the big employees there. You've got lots of banks: Morgan Stanley, Lloyds Bank. You've got Deloitte, PwC, other companies employing many people across Amazon, Skyscanner. A big industry in terms of drinks. You have Innis & Gunn. You've got Edinburgh Gin. Lots of startups. A very diverse economy. And as I say, a very prosperous city, having spent 2 days walking across the city, north, east, south, and west. Next slide, please, Bella. So just in terms of some numbers relative to what we've been speaking about today, an undersupply rings very true. Strong undersupply, just 41% of the city's housing needs have been fulfilled over the last 9 years. So, you know, COVID has got a lot to do with that. Very, very undersupplied. And we're talking about 29,000 homes shortage until 2031. I mean, just quite incredible. Prices, they're above the national average. And as I say, because of the economic strength of the city, we see strong growth over the next number of years in terms of capital appreciation and also in terms of the rental market. You know, there are some very decent yields there. I mean, yields are sort of 5%. You can confidently expect investing in parts of Edinburgh is a very strong and stable yield. So let's just move on to the next slide. So we've got an upcoming project in Edinburgh. So we are looking at a project on the west side of the city. We are just finalising the pricing at this moment in time. The project is not far from Murrayfield, the famous rugby stadium there on the west side of the city. We are looking at a project with an award-winning developer that we've worked with 6 times previously. We are looking at unit prices from 210,000 up to for 1-bedrooms and just over £300,000 for 2-bedroom units. And actually, I went with a friend to the location, and they said to me, yes, this is a real great spot to invest. It's very much a sort of what I would call a bread and butter IP Global project. It's an area where it's cheaper to rent and buy. The regeneration on the west side of the city is growing and developing, and this is a spot we've found where literally you'll be into the city centre in 10 or 15 minutes. So perfect for young professionals looking to rent and buy in an area where it's good value and they can get to their places of work very, very quickly. So please look out for that project, which we hope to launch into February. And also, in terms of new launches, we are currently finalising a project in Sheffield. Sheffield is a city that we have invested in before. It's a city that's undergoing an awful lot of investment. From the old steel days of the 80s, it's transformed itself with new companies such as Boeing, HSBC, Tata Motors, and others. And the infrastructure is just getting better and better. We have the HS2 plan to come into Sheffield over the next number of years. And you're looking at sort of buying a studio apartment in the city centre from not far over £140,000 with a 6% yield. So this is certainly a great city to invest in. Next slide, please, Bella. So just before we come to questions, if we look at, you know, what do we have right now? We have projects in Manchester and Birmingham that will be completing by the end of the year. We have a project in Hull, which is a very strong renewable energy centre from £120,000 completing next month for those clients who want to get their cash in quickly and get a really strong yield. And we have the beautiful city of York, where we have a project completing in Q3 of this year. I've been to the projects in York, fantastic location, 23,000 students, Russell Group universities, tree-lined streets, very similar to Edinburgh in many respects, beautiful city, and there's a lot of waterside regeneration planned, and I think that will be a standout place to invest over the next few years. Manchester, again, continues to go from strength to strength. I was at that location actually in October. Again, a great value spot we found with an award-winning developer. Around about £350 a square foot. You know, you're going less than 10 minutes away and you're paying up to £500 per square foot. So a really great value opportunity. We've got the whole airport in Manchester that's being tremendously invested in at the moment. We've got HS2 into London. We've got Media City in Manchester, which is like an equivalent of Canary Wharf in Manchester, which is going to double the size of its footprint to 60,000 employees over the next 20 years. And then finally, sort of bottom right, yeah, Birmingham. Birmingham is unrecognisable from when I was growing up in the UK. It's a fantastic city now. It hosted the Commonwealth Games last year. You've got all the big corporates from London there. When the HS2 goes in, the high-speed train link, it'll almost be commutable into London, just over 45 minutes. And that building is a period building with a developer that we have worked with before that builds these grade 2 listed buildings to an incredibly high standard, and wonderful developer, which is purely cash based, and they build to the very highest standards. And the Jewellery Quarter in Birmingham is just a super area to live in, just on the edges of the city centre. So that's what we're up to in the UK. If we go on to the next slide, we just have recently been to Leipzig and Berlin with my colleague David. I was there in October, November time. It was great to be on the ground. Leipzig is a city that some of you may have heard of, some of you may not. It's a city only an hour from Berlin. It's like a feeder city into Berlin. It's the fastest growing city in Germany. Why is that? Well, it's had an incredible 20-year investment plan since the fall of the Berlin Wall, which has encouraged those who left Leipzig when the wall fell in 1990 to come back. And there's been an awful lot of investment across many different sectors of industry, which has brought back the population to now being over sort of 600,000. It's got incredible infrastructure, great road and railway network. It's DHL's European hub, one of the biggest cargo airports in Europe. And you have so many German corporates there because it's easy to export their goods across Germany. And the fact is, if you went in the city centre, he's got an amazing internal transport system, and all the big corporates like PwC, Deloitte, KPMG, etc., that you see in Hong Kong and Singapore and elsewhere are there. But property prices are just now starting to turn the corner, and we see really strong value. We see 5% yields, and Germany, great legal structure and super tax benefits. You hold in Germany for 10 years and there's no capital gains tax. And finally, the Sun House project. So this is for clients who are looking for the EU passport. You can invest in Portugal from 280,000 euros. You can secure a property, and that also will secure you the EU passport, which will give you the rights to live in Portugal, travel visa-free through the Schengen region, and other benefits such as health benefits, etc. And that's something we've seen a lot of interest from our clients here in the UK, a lot of American clients, and a number of others. So that's somewhere else that we can help with investors. So let's go to questions now. I know there's quite a number of questions that have been coming through, so we will go to questions in a second, just while they come through and are collated. But just before I do that, just to share with you all, I will be in Singapore and Hong Kong very soon. I'm looking forward to that trip, to get out of the cold of the UK. So I'm doing a couple of events. I will be at the Fullerton Hotel on Wednesday, the 1st of February at 8 AM, a breakfast event. I will also be at the Tower Club on Thursday, the 2nd of February, also starting at 8 AM, where I will be covering all of these projects. And I will be in Hong Kong on Wednesday, the 8th of February at DocCod in Central. And I will also be available for individual meetings. So if you would like to attend, or you would like to see me on a one-to-one, do drop a line, and we can certainly secure you a place at the event or a meeting with myself. So let me just look at the questions. I will just see what questions we have coming through. Okay. Right, so first question here. Except Edinburgh, you mentioned, any other cities in UK where you see great rental potential? Okay, well, I think, you know, just the strength of the rental market here means effectively any city centre you invested in is going to provide you with a tenant quickly and likely increase in rents from 12 months previously. Of course, from our perspective, we're trying to bring the best of the best opportunities. And what I can tell you is of the 5,000 properties that we manage, we have next to no availability across that whole portfolio. I mean, it's an extremely strong rental market. So I think ultimately, wherever you invest in any of our projects, and as I say, across the UK, the rental market is strong. I think I'd flag the Sheffield opportunity with the fact that the yields are very strong there. We're talking about sort of 6% yields. But as I say, if you look at Manchester, Birmingham, you're looking at yields very, very healthy. You're looking at investing in areas where, there's regeneration, there's a lot of jobs being created. Hull, you're looking at sort of close to 6% yields, York, sort of 5%. So, ultimately, I think it would depend on how much capital you want to invest for the particular opportunity. But the rental market, as I say, has long-term fundamentals in it in the UK. Okay, next question. Should I wait for the interest rate to come down before I invest? It's a good question. Again, I think the point I would make is you're never going to get everything when you invest. Not everything's going to be aligned. But what you're going to get now, if you're investing, as I say, there's been a window of opportunity where we can negotiate very good pricing right now, with the fact that transaction levels will be a little bit lower because of interest rates going up. So the deals we're negotiating will be excellent at this moment to take advantage of where precisely the market is at this point. But of course, as I say, I see the pound strengthening through this year. So I think it pays to lock in now, because in effect, you're going to lock in the currency at this point. You can get your funds transferred, etc. And then, of course, with the mortgage inside, if you think about it, most of our opportunities are completing in a year, 18 months. So actually, you're not going to be doing the mortgage for a year or so, by which time I believe the landscape will look very, very different to how it is now. I think we'd have gone through a curve of the rates rises, the rates stop rising, stability, rates coming down, and mortgage rates being priced better as well. So I think now is absolutely a very, very good time to invest into the market. What is the rental demand in Edinburgh? Okay, again, when we talk about those specific numbers in Edinburgh for undersupply, what I can tell you is, and speaking to agents on the ground during my trip, rental market is very strong. The yields will be around about 5%. I spoke to a number of agents in Scotland. They've seen sort of 10% rental inflation over the last year or so. And, because of the geographical makeup of the city, the old historic buildings, Roman walls, etc., stock levels are particularly tight. And as I say, we've done projects in Edinburgh before, so we know it's a great long-term rental market. Okay, next question. Given the uncertain situation, should I go for fixed or variable rate mortgage? Again, a very good question. My personal feeling would be, as I say, when you're looking to invest, the time by which time you get your mortgage, I believe over the next year or 2 years, we'll see interest rates coming down. So my personal preference would be to go for a variable rate once you do lock into your mortgage. So let's say you arrange a mortgage in 12 months' time. I think we'll be on a trajectory at that point of rates coming down. So I personally would look at a variable rate to take advantage of that. And of course, once we get to a point where we feel rates are stabilized, perhaps they have leveled off, then obviously at that point you can lock in a fixed rate. It can be quite fluid with mortgages, that you can obviously, once you've opted for one type of scheme, at some point, of course, you can then alter that. So I think personally, I would opt for a variable rate mortgage at this time. Okay, I'm just conscious of the time. I like to keep these under the hour, so I think I'll take one more question. I do apologise, there's a lot of other questions here, and we will come back to you with those. Except Manchester and Birmingham, these popular locations for investment, is there any other city you'd recommend for great yield, rental income, but with lower entry budget? Okay, I think if we're very budget conscious, I think the standout markets would be Hull. As I say, Hull you can invest in from £120,000. I do think that's a great city to invest in. It's been totally transformed in recent times. Great affordability there. I mean, it's 4.2 times average salary to invest. If you look at London now, it's 12 times average salary. So London is quite stretched from an affordability perspective, but Hull is tremendously affordable. We've seen a lot of investment there going in. It's been European City of Culture. We've seen renewable energy. You've got Yorkshire Wind Power. You've got Siemens invested heavily there. It's a great value spot. You've got the new port coming in. There's transportation linked to the Northern Powerhouse. And all these factors tie in with a really nice project we've got. It's like a converted old brewery in a very central location, close to employment hubs and theatres and so on. So I would flag that. And I would also flag Sheffield upcoming, where, you know, one of the sort of key cities in the UK, you know, you're effectively buying property for just over £140,000 a studio unit. As I say, with around about a 6% yield, a feeder city into Leeds and others, but considerably cheaper with the HS2 coming and all the benefits that brings as well. So I think we will draw a close at that point to the webinar. I do hope that the information I've shared today with you has been helpful. It's given you a good perspective on the UK market, and it's helped you with some good food for thought for investing here in the UK. As I mentioned, I am upcoming in Hong Kong and Singapore if you'd like to meet. If you have any other questions, if you want any further information, do drop me a line. But until we speak again, until you join another webinar, as I say, thank you very much indeed for joining. I wish you a good rest of the week for those in Hong Kong and Singapore. Kung Hai Fat Choi. And yeah, I look forward to seeing you all again soon. And thank you very much indeed for joining today. Thank you.